All right, let's talk about something you might have heard of but aren't totally sure about: peer-to-peer lending. We're going to break down what you need to know about this alternative investment and explore how, in a way, you can actually become the bank. I mean, who isn't, right? It's a question pretty much every investor asks themselves. With the interest rates you get from a regular old savings account feeling, well, pretty uninspiring, a lot of us are looking for ways to make our money work a little harder. And that, right there, is where P2P lending really enters the conversation. So here's our game plan. First, we'll cover the basics, what P2P even is. Then we'll look at why it's so tempting. After that, we'll talk about the all-important step of choosing a platform, get real about the risks involved, and finally, wrap it all up with a smart playbook for investing. Okay, so let's start at square one. What exactly is this model? How does it let you just sidestep the big traditional banks? At its heart, P2P lending is actually a pretty simple idea. Think of it like this. An online platform plays matchmaker. It connects people who have money they want to invest, that's you, directly with people who need to borrow money. And just like that, the traditional bank is completely tut out of the picture. And honestly, this is the perfect way to think about it. You are stepping into the role of the lender. So instead of putting your money in a bank, which then lends it out and keeps most of the profit for itself, you're the one lending it out. And that means you get to keep a much, much bigger piece of the interest payments. So that naturally leads us to the big question. What is the appeal here? What's making this model so attractive that more and more investors are starting to pay attention? Okay, let's be real. This is the number that gets everyone's attention. The potential for higher returns is, without a doubt, the number one reason people get interested. Because these online platforms don't have the massive overhead of a giant bank, more of the interest paid by the borrower flows directly to you. We're talking typical rates somewhere between 5 and 12%. Now, it's super important to remember that higher potential returns almost always mean you're taking on higher risk loans. And when you put those numbers side by side with what you might get from a regular savings account or even some bonds, well, you can see why people get excited. It's a completely different ballpark of potential earnings, which, could help you hit your financial goals a whole lot faster. But hey, it's not just about the interest rates. P2P is also surprisingly accessible. On many platforms, you can get started with just a few $1,000s. And here's a really crucial point. It offers powerful diversification. See, a loan's success depends on an individual paying it back, not on what the stock market is doing that day. So it isn't directly tied to all those market swings, which can be a really valuable cushion for your portfolio when the market gets choppy. Okay, so I know what you're thinking. The potential here is tempting. But before you even consider jumping in, we have to talk about due diligence. Seriously, the platform you choose is hands down the most important decision you'll make. All right, so here's what you absolutely have to look for. First up, does the platform partner with a real bank to hold the funds? This is non-negotiable. It protects your money if the platform itself goes belly up. And second, you gotta dig into their risk controls. How do they actually screen borrowers? What are their historical default rates? Do they require collateral? You need the answers to these questions, and you can usually find them right on their website or in the prospectus. Now, before we get too carried away, let's pull back for a second and get brutally honest about the risks. Because those high returns we were just talking about, they don't come for free. Understanding the risks is every bit as important as understanding the rewards. So there are two main hazards you have to be aware of. The biggest one, by a mile, is default risk. That's the chance that the person you lent money to just can't pay it back. If that happens, you could lose all the money you invested in that loan. The second one is liquidity risk. This isn't like a stock you can just sell in a heartbeat. Your money is tied up for a fixed period of time, often for several years. So how do you fight back against that single biggest risk, default? The answer is one word: diversification. You never, ever put all your money into one loan, or even just a handful. No way. Instead, you spread it out across dozens or even better, hundreds of tiny little loans. That way, if one loan does default, it's just a tiny little dent in your overall P2P portfolio, and the financial hit is minimal. All right, so we've seen the good, the bad, and the ugly. Let's pull all this together into a simple, straightforward playbook for how to approach this smartly. Here are the 3 golden rules. 1, diversify aggressively. I really can't say that enough. 2, know what you're getting into. This is a fixed income style asset. It is not a get-rich-quick scheme. And 3, maybe the most important rule of all, never, ever use leverage. Do not borrow money to invest in other people's loans. The risk just skyrockets. And that brings us to what might be the single most important piece of advice to take away from all of this. P2P investing should be done with idle money. We're talking about funds you don't need for your daily life, not your emergency fund, and money that you're comfortable having locked up for a few years. That is just a core principle for investing responsibly in the space. So there you have it, the potential for some really attractive returns, but it comes with real risks that you absolutely have to respect and manage with a smart strategy. The big question, the one only you can answer, is whether this unique kind of investment makes sense for your own personal financial journey.